Welcome back to Turning Hard Times into Good Times. I'm really pleased to have with me another Michael. This is Michael Oliver, who's been with us very often. In fact, I think the most frequent guest we've had on our show. And I would just say, remind you that the place to go to follow what Michael does and to sign up for his service is olivermsa.com. Oliver, M as in Mary, S as in Sam, A as in Albert.com. Well, Michael, we just discussed with Michael Maloney that we are now facing what he calls the greatest crisis in the history of mankind. Now, that sounds a bit hyped. Michael does sell gold and silver coins, but he also does a lot of good educational work. He's not a technical analyst like you are. I like to rely on technical analysis because I think it puts the emotions aside and the feelings and the ideas aside and lets the market do the talking. And you have your own unique way of looking at momentum and structure, which I find is very helpful and has been very helpful to me. So I'm glad to have you back again. From your point of view and from your work as a technician, what do you think? Do you think Michael might be a little bit overstating the situation?
No, I can't disagree. My only issue is whether it comes in some fairly dramatic downdrafts, crash type situations here and there, or whether it's a layered process that takes a couple of years. Mm-hmm. I'm open to either. I can't deny the potential for a massive downdraft, let's say, further in stocks. Frankly, I expect to see it in the 1600s in the S&P probably in the first quarter, maybe next week. I don't know. It's done enough damage to where the door is wide open now, as far as I'm concerned. That's the S&P.
But the direction is pretty certain, I believe. In terms
as far as I'm concerned, it's done. It's a done deal. 2015 warned, 2016 put the final nail in it. And, back in December before the year closed, I was noting to my subscribers, and even the Wall Street Journal picked up on it and ran the article, that it's time to lock and load was the quote I used, and I guess they liked the sensationalism of that. So they put it in the article. And the reason I said that is we were trading back then. Remember, we made our low in August in the 1800s and then rallied back into the 2000s on the S&P. Mm-hmm. We're comfy, back up, traded up 2100. Got back within 30 points of the high of the year. So it really looked good and comfy, and you closed the year at 2043. The problem was from annual momentum perspective, not a price chart perspective. Because remember, at 2043, where you closed the year, you were 170-plus points above the August low, so it felt comfy.
Yeah.
But from annual momentum, as soon as we opened the new year, by not being above 2090, I blew out a 4-year floor on annual momentum. So it basically was like, walking through a floorboard of huge dimensions. And so the tone and temper of the market was fitting to what it did to momentum. It no longer had support. So what happened, we immediately went back down to the 1800s. And I don't think that's the end of it. I think it's the start of it. And I think, it will probably last the bear market at least into 2017 and maybe even longer. And then the question is, what ultimate depth do you get? And frankly, I can't deal with that issue. I can deal with it in layers, and I suspect that the next major low has a shot of being in the low 1600s, which is a considerable further distance. The other market I'm really keen on, of course, is the one your previous guest talked about, was gold. I'm of the view gold's not going to make a new low. That the low at 2040 and change last year was it. We're now just below 2090, quiet, behaving. The main feature about gold that I pay attention to, other than its momentum in price, is its spread relationship to the S&P 500. That's two assets compared one to the other. And therefore I run what's called spread charts, or some people call them relative performance charts, where I divide the price of gold into the S&P and I plot it. I also run long-term momentum of that spread. Right now, gold is trading at about 57% plus the price of the S&P. If you divide gold into the S&P, you'll end up with a percent of about 50. If you close out this month at that level, I argue that the base is in place for gold to now begin to outperform the S&P again. Remember, the S&P beat the pants off gold beat the pants off the S&P from 2000 through 2011, big time. Mm-hmm.
Yes.
Huge percentage gains. But then it suffered its corrective down move in the spread, coincident with its price down move, and dropped back down to 57, about 51% versus the S&P. It's now firmed up to about 57. So I'm keenly watching that, because I think if that breakout occurs on the relative performance basis, that will probably be coincident with a price and a momentum breakout in gold. Fairly coincident. Mm-hmm. I'm still of the opinion, which is hard to prove when you look at the price action of, like, the gold miners. For example, the GDX, which is an unleveraged ETF of gold miners. It's making a new low today. Gold is not, but the GDX just blew out a 6-month wide floor of price that anybody could see just looking at the chart. I'm not impressed by the new low. It doesn't spook me at all. It's trading around $12.50 on the GDX. I've now lowered my buy number. If you trade back up to 15 and close any week at $15 or more, as far as I'm concerned, it's over. Mm-hmm. It's turning. And I think that there's a good possibility that the miners will beat the metals in the next upturn, which is, of course, they've not been behaving better than gold for the last several years. But I think that could change, despite today's weakness in the gold miners.
Yeah, or maybe because of it, in part, because we're looking at such a low, undervalued. Well, is it what? I guess the correlation has to be, in part, the weakness in the equity markets as a whole, because you have people with their portfolios and they've got to liquidate, they got to sell, or people just selling whatever.
Yeah, they are stocks, after all. Yes,
yeah.
I agree.
Yeah.
And also people are looking at other mining stocks that are not gold-based, iron ore stocks and copper stocks and so forth, and they're basketing them together, and that's a mistake. Yeah.
Oh yeah, that's a pretty big mistake, I think. Well, you've talked about these major plate tectonic changes. You started talking about that last year already, and so do you think we're here? I think we were looking basically at debt, equity and debt, probably seeing a shift towards a bear market, and precious metals and commodities as a whole, although, as you've pointed out, often certainly not in tandem. What about some of the key commodities? Oil, for example, is the big one. That's what everybody's watching. Nobody seems to have a handle.
Oil is the Judas goat of certain vulnerable markets. In other words, it was the last commodity to turn down hard. Most commodities peaked in 2011 or 12 and got the stuffings beat out of them by 2013 or 14. Well, oil didn't even break down until August, for my work, $96. I put out a major sell signal in August of 2014, so it was way lagged to the general commodity downturn. But because it is such an important commodity, everybody's focused on it. Meanwhile, corn and sugar are bottoming and turning up, and nobody's noticing that. But oil, I think, because of its weight, its gravity in certain stocks and debt instruments, is a Judas goat. In other words, it's not going to quit doing what it's doing until it sees screaming and blood in certain other markets. Now, we're getting that in the high-yield debt market. We're getting screaming and blood. And we're only now, recently, in the last 2 weeks, getting it in the S&P. And I think once the S&P has demonstrated that it's screaming over the edge, at that point, the oil market will have done its job, so to speak. And I think that, like any market, it can overshoot its fundamental justified levels. And I know a lot of people, when the market gets low, nobody was bearish at 96, and everybody got bearish at 40, and now it's going to go to 10. So I don't buy into that. I'm looking for a low in oil, and I'm looking for it probably coincident with the first S&P low. So, for example, if the S&P does drop in the Q1 or in the next few weeks down into the 1600s and generates a trading low there, I'd look for oil to be bottoming at about that time, and quite possibly making a low that it doesn't come back through. And at that point begin to divorce itself from the stock market. At which point commodities as a basket, I think, are once oil is finished as a basket, I think commodities are ready to turn as an asset category against the S&P.
Well, certainly when oil turns and bottoms, it's going to start getting people to look at the commodities in general, I suppose, then, huh?
I think so. And like I said, some of them, if you look at a corn chart or a sugar chart, sugar is arguably in a bull trend, a recent emergent bull trend. So a lot of these essential commodity markets that we don't talk about because everybody's focused on oil, they're turning, and in convincing ways. And So you don't see the same thing you see in oil that you see in other markets. So oil is definitely the screaming one, and it's grabbing the headlines, but it's not the state of the commodity world. It doesn't truly reflect it right now. It's late, it's a laggard, and it's a noisy one.
No, you certainly have been right on the nose on the high yield debt, and you put out something today for your subscribers that I think is very interesting. My engineer is telling me we're basically running out of time, but the high yield HYG you're showing here is really breaking down big time now, isn't it?
Yeah, we got bearish actually back in early 2014. The spread started to change where you could see the investment money going into U.S. Treasury debt and out of high yield. And that helped cause the HYG and other ETFs like that to start down. But it's been a slow downward movement. Now it's accelerating to the point where I think we're ready for what you might call a reverse blow-off.
All right, we're going to have to leave it go at that, Michael. Thank you very much for being with us again. Always great to have you.